Hey, welcome back, my fellow IB macroeconomics students, to this video lecture. Today, we are going over monetary policies, okay? So monetary policies concerns the policies concerning money the bank, a central bank does to the economy. Now, let's go over some definitions, why don't we? So monetary policy is defined as changes in interest rates, exchange rates, and money supply to influence aggregate demand by the central bank. Now, what's the difference between monetary policy and fiscal policy? Now, that's a very valid question. It's a lot of students, okay? Many students do not get the difference between monetary and fiscal policy. The biggest difference, fiscal policies is in charge by the government, okay? Because fiscal policies concern taxation, it concerns government spending. Monetary policies, on the other hand, are in charge by the central bank, right? For America, it will be the Federal Reserve. For other countries, it will be the central bank. That which is different, okay? It's a different entity from the government because the things they could do to influence the market is different. Monetary policies includes, most prominently, okay, it basically is just interest rates. Now, under interest rates, a lot of people often have the misconceptions that interest rates is just one thing. However, interest rates actually is a lot of things, okay? There's interest rates, borrowing rates to businesses, there's borrowing rates to individuals, there's the mortgage rate. So the interest rate is actually a lot of different things combined together. So when we hear about European banks having negative interest rates, that does not mean every time you borrow some money, it will be having negative interest rates. That is just for the business sector. For the mortgage sector, we still have positive interest rates here in Europe. Okay. So that's interest rates. Interest rates is the main tool, is the big tool that monetary policies and central banks use in order to influence aggregate demand. So both fiscal policies and monetary policies are trying to influence aggregate demand. So let's see the two types of monetary policies. There are the expansionary monetary policies and the contractionary monetary policies. So expansionary monetary policy could be something like decreasing interest rates, such as even negative interest rates here in Europe, or contractionary monetary policies are anything that contracts the economy, such as increasing the interest rates and therefore decreasing the money supply and decreasing the aggregate demand. Now, why in the world would governments want to decrease money supply? First of all, to reduce inflation. Now, as we all know, when there is a huge sum, okay, when there's too much money supply in the economy, what happens? Inflation occurs. Okay, there is more money than there are goods in the market. Therefore, inflation occurs. So, one of the main causes that governments will like to decrease to increase their interest rates and actually to decrease their aggregate demand is to reduce inflation. So that's a major thing. Another thing is to prevent unstable asset prices. Now, what is the most expensive asset that the average consumer, average household has? It's their house. It's real estate. Okay, real estate is a very expensive asset. Now, central banks or Federal Reserves, if you live in America, want to ensure that asset prices, such as houses, are stable and not out of control. If borrowing money is so easy, it's at a point that's so easy, then borrow money will be so easy, and asset prices will just go out of the roof. House prices will go out of the roof because everybody could buy houses. This is a lot what happened in the 2008 financial crash, mainly brought about by unstable asset prices, especially the housing bubble. Okay. So another role of the monetary policy by the federal banks or the central banks is to prevent unstable asset prices and to ensure that asset prices are indeed stable. Okay. So another reason for contractionary monetary policies is to prevent excessive debt. Okay. So when interest rates are really low, borrowing becomes really easy, and people actually borrow a lot more. However, a lot of harms when it comes to borrowing is that debt becomes uncontrollable. Okay, people borrow so much money that they're in so much debt. Now, governments do not want debt to be a big problem. Governments do not want excessive debt. Now, why? Because debt is basically borrowing from tomorrow. Excessive debt today will cause growth tomorrow to be hindered because they're borrowing from tomorrow, and tomorrow they have to be paying back their debt. So that is why central banks and federal banks also want to reduce or limit excessive debt in the form of cutting interest rate of increasing interest rates, reducing the aggregate demand so that preventing excessive debt from occurring. Now, another major reason for contractionary policies is to reduce account deficit, that which is to, pay back debt. Because a lot of times when interest rates are so low, governments, firms, companies, individuals borrow so much money that they have so much money, they owe so much money, right? So by increasing the interest rates and decreasing the aggregate demand, consumers, governments, firms, companies gets to pay back what they have borrowed and to actually reduce account deficit. So those are the reasons for contractionary monetary policies. A lot of times when we hear the government is increasing interest rates and they're contracting the economy, or excuse me, in this case, the central bank is increasing the monetary policy and they're cutting back on the money supply, we wonder why the hell would they do that? But now you know there are these 4 reasons: to reduce inflation, to prevent unstable asset prices, such as unstable or bloated real estate prices, to prevent excessive debt, and to reduce account deficit. So those are the contractionary monetary policies and their effects. Now, expansionary policies are not that hard to understand. Governments, central banks want to reduce unemployment, increase money supply, and access to credit will cause firms to have more money. And when companies and firms have more money, they can able to hire more employees, and effectively reducing unemployment. So that's not hard to understand. Increased growth, when there's excessive amount of credit, leading to excessive amounts of aggregate demand, where aggregate demand increases on the AD curve, the corresponding real GDP shifts to the right. Okay, so that's not hard to understand. Increased inflation, once again, that may be a good thing, may be a bad thing, depending on the type of inflation. Okay, so now that we have talked about the expansionary and contractionary monetary policies, what do these things look like on the graph? So let's look at this graph right here. This is the Keynesian interpretation of macroeconomics. We have the long-run aggregate supply curve right here. We have 81, 2, and 3. When expansionary fiscal policies are enacted, that means cutting interest rates even to the negative points, like we have here in Europe. 81 gets shifted to 82. Why? Because there is an increase in aggregate demand. Aggregate demand gets shifted to the right. Now, when 81 gets shifted to 80, to the intersection to LRAS gets higher. Therefore, real GDP increases. Okay, real GDP increases. Now, why does 82 shift to 83? Why in the world would 82 shift to 83 when monetary policies are enacted for 81? Now, that's what we call the multiplier effect. Now, if you do not know what the multiplier effect, please go back to my video on the multiplier effect. That is a very important, es un película muy importante, that you understand the multiplier effect of the Keynesian multiplier effect. And I'm just gonna give you a quick summary. When a person spends money, okay, when a person spends money, the money becomes somebody else's income. And that person gets to spend his income. Okay, so that's basically the multiplier effect in a nutshell. If you do not know, por favor, go back and look at the last video I did on the multiplier effect. Muy bien. The next, once again, this is the long run in the classical view. When there are expansionary monetary policies, LRAS gets shifted to the right. Long term aggregate supply, when the economy is at full employment rate. Okay, so I hope this video is helpful actually in talking about monetary policies and actually debunking some misconceptions that such as contractionary monetary policies are always bad. I went about expansionary and contractionary monetary policies as well as what they look like in graphic form. I hope this video is really helpful for you. If it is, leave a like and subscribe, and I'll see you guys in the next video where we will finally be reviewing the entirety of the macroeconomics syllabus. Guys, we did it. Okay, goodbye.